experience that we had in the decade 2000 to 2010. The gold price escalated, if my memory serves me correctly, from $253 to some number like $1,700, a 7 or 8-fold increase in the price of gold. I'm not saying that we're going to get that dramatic a move, but let me put it differently. Let me suggest to you that the gold price in the period 2000 to 2024 hasn't moved up at all, that the dollar has in fact moved down, that it takes more dollars to buy an ounce of gold, but an ounce of gold buys you the same amount of goods and services as it did in 2024. If you look at it from that metric, my suspicion is that the next 10 years will be very good for gold indeed, measured in dollar terms.
RickRule, the founder and president of Sprott US Holdings, is renowned for his deep expertise in commodities markets and his contrarian investment approach. Rule has long advocated for gold as a hedge against inflation and currency devaluation, noting that the precious metal has risen by around 8% annually since 2000. In his view, gold's value isn't just tied to its ability to protect against inflation, but also as a safeguard against the declining purchasing power of the US dollar. Recent market activity has reinforced the relevance of Rule's insights. Gold prices surged nearly 1% on Thursday, trading close to record highs as geopolitical tensions fueled safe haven demand. By the end of the European session, gold reached $2,743.15 per troy ounce, although it slightly pulled back following positive U.S. macroeconomic data. Despite this, demand for the U.S. dollar remains subdued, further supporting gold's upward trajectory. Similarly to the 1970s, when gold saw dramatic price increases, Rule predicts that the next decade could significantly raise gold prices, primarily driven by soaring government debt and deficits. On Wednesday, gold hit another record of $2,759 per ounce, before settling back to $2,729.40, marking a 32% yearly rise. Broader economic concerns are also fueling this surge in gold prices. The International Monetary Fund has warned that global public debt is set to reach $100 trillion this year. Within 3 years, this figure could rise to 115% of GDP, a level of debt that threatens to destabilize the international financial system. With the U.S., long considered the cornerstone of the global economy, facing mounting liabilities, the case for holding gold as a store of value has never been stronger. For investors like RickRule, gold is more than just a commodity. It is a crucial asset for preserving wealth in the face of economic uncertainty and escalating debt burdens. As global debt rises, gold's role as a safe haven asset will likely grow even more prominent in the years ahead. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I've said on your show before that I don't own gold because I think it might go through 2,700 or for that matter 3,000. I own it because I'm afraid it's going to go to 9 or 10,000. Will it do that in lockstep as a straight line? No. If you're a trader, if you're somebody who's afraid of volatility, if you can't afford to remain long, by all means take trading profits. That's not how or why I own gold. I own gold to maintain my purchasing power. By my measure, gold didn't start moving 3 years ago. Gold started moving in the year 2000. If you look at the 24 years that we've been through, gold has increased in price by about 8% compounded a year for 24 years. Gold has maintained my purchasing power, which is precisely why I own it. Is the pace of the escalation of the gold price picking up? Yes. And in the face of political pressures on the Fed to lower their interest rate, which is a different way of saying devalue the yield on the U.S. dollar, should gold continue to accelerate? Yes, if all other things remain equal. Again, though, your technique with regards to gold, your strategy with regard to gold, will relate more to you than to gold. Doug Casey's old joke is that the U.S. dollar is the worst currency in the world, except, of course, all of the others. In my experience, markets like the markets that we're seeing now, markets where the pace of gold appreciation escalates, sees gold appreciate not just in U.S. dollar terms, but concurrently with the U.S. dollar, which means in other currencies, gold isn't merely appreciating, it's rocketing. This is not inconsistent with the experience that we had in the early part of the decade of the 1970s. It's also not inconsistent with the performance of gold relative to other currencies that we experienced early in the decade 2000 to 2010. This is completely concurrent. with the ramping up of a gold bull market. Whether past is prologue or not is a different question. I believe it is. Important that you remember that the decade of the 70s saw the legal decontrol of the price of gold. In the early part of that decade, gold had been price controlled, as it had been for 30 years at $35 an ounce. So part of the move that you saw in the gold price in the decade of the 1970s was the simple removal of price controls and the legalization of gold ownership by Americans. Remember that in that decade, and some of your listeners are too young to remember, that the gold price went from $35 an ounce to $850 an ounce. My suspicion is that had gold been decontrolled and Americans had been allowed to own it, that it would have begun the decade at $100 or some number like that, so that the escalation in price would have been eightfold. That's consistent with the experience that we had in the decade 2000 to 2010. The gold price escalated, if my memory serves me correctly, from $253 to some number like $1,700, a 7 or 8-fold increase in the price of gold. I'm not saying that we're going to get that dramatic a move, but let me put it differently. Let me suggest to you that the gold price in the period 2000 to 2024 hasn't moved up at all, but rather that the dollar has in fact moved down. That it takes more dollars to buy an ounce of gold, but an ounce of gold buys you the same amount of goods and services. If you look at it from that metric, my suspicion is that the next 10 years will be very good for gold indeed, measured in dollar terms. Here's why. In the decade of the 70s, we alleviated the stress of debt and deficits. We alleviated the overvaluation of the U.S. dollar. By the U.S. government's own estimates, we devalued the dollar in terms of its purchasing power by 75% in the decade of the 70s. I believe that past is prologue. I believe that the dollar will buy you 75% less in goods and services in the 10 years coming relative to today. The on-balance sheet liabilities of the U.S. government are $35 trillion and counting. The off-balance sheet liabilities of the U.S. government are $100 trillion and counting. I don't believe it's physically or politically feasible to renounce things like Social Security, Medicare, Medicaid, and I don't believe that Congress is going to stop spending.
The silver market continued its upward trajectory on Thursday, with silver prices rising to $34.26 per troy ounce, marking a 1.63% increase from Wednesday. Silver has seen a substantial rally this year, up 43.96% year-to-date, as investors increasingly turn to precious metals amid global uncertainty. RickRule notes that this dynamic aligns with historical trends in previous bull markets. Silver often lags behind gold initially, but when it begins to move, its volatility and lower price per unit tend to attract generalist investors, leading to rapid gains. Rule emphasizes that while the reasons behind this pattern aren't entirely clear, it has been a consistent feature in past precious metals cycles. Silver showed signs of regaining momentum on Thursday after a brief pullback over the previous 24 hours. While the rally was modest, it is no surprise that silver faced some cooling off, given its recent surge. The temporary retreat appears to be a healthy correction after silver had potentially overextended itself in recent trading sessions. Even if prices dip further, there is strong support at the $32.50 level, suggesting that silver's uptrend remains intact. As the silver market consolidates, many investors are watching closely to see if it can sustain this momentum. However, with strong historical performance and continued demand for safe haven assets, the long-term outlook for silver remains positive. Let's get back to the interview.
As you and I have discussed in prior interviews, if past is prologue, the momentum in a gold bull, in a precious metals bull market is set by gold. The first buyer is the fear buyer. And it's only after gold has established the precious metals narrative among generalist investors that silver begins to move. But when silver does begin to move, it goes further and it goes faster. Whether or not we have reached this tipping point or not is a subject open to conjecture. But the performance that we've seen thus far, the relative performance between gold and silver, has been borne out in prior bull market cycles. I am not sure why this set of circumstances occurs. I can just tell you from observing 4 prior precious metal cycles that does seem the way it performs. Perhaps when the generalist investor comes it gets attracted to the precious metals narrative and comes down into the space that the higher historic volatility of silver and the lower unit cost of silver attracts them. Two comments. One, the lack of performance overall of the gold shares relative to gold is easy to explain. Until 20 weeks ago, the buyer of gold was mostly central banks. There was no retail participation, and central banks don't buy gold shares. So if one market went up because there was a buyer and that buyer was absent from the other market, I think it completely explains the dichotomy. In terms of the relative outperformance of Newmont relative to Barrick, I think it has to do with the fact that Barrick has guided their production lower and Newmont has guided their production higher as a consequence of their acquisition of the assets of Newcrest. I think that there's a belief on Wall Street that Newmont's stated strategy, which is to sell all of their Tier 2 deposits, use the proceeds to strengthen their balance sheet, and focus their love, care, and attention only on their Tier 1 projects, is something that's caught Wall Street's fancy. But I think generally that gold equities bull markets are always led by the biggest and the best. So you're seeing names like Agnico Eagle and Franco-Nevada and Newmont, the low-stress names, catch a bid first. That's traditional. We've seen that through the last 4 precious metals bull cycles. Think of a gold equities bull market as resembling the trajectory of a circus master's whip. The lower risk companies are at the front of the whip. They move first, but they have the shortest distance to go. Mid-tier producers are next. They move after the top producers, but they move further. And then finally, of course, at the end of the bull market cycle, you have the penny dreadfuls. They move last, but they move the furthest. It is possible, if you pay attention, that your own portfolio can match that same trajectory, albeit you take increasing risk, both in terms of the companies and in terms of the fact that when the worst companies move, you are towards the end of the bull market. So you run the timing risk.
Both gold and silver continue to demonstrate their strength as reliable assets during economic uncertainty. With gold hitting near record highs and silver showing consistent gains, the demand for these precious metals remains strong amid rising global debt, as investors seek protection against currency devaluation and financial instability. The long-term prospects for gold and silver remain highly favorable. Do you believe the current global economic conditions will continue to drive the demand for precious metals, or could market adjustments slow their momentum? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.